Join our new, simpler, free room where we break down the foundations of our trading for those who are looking to gain financial freedom in the markets. Check out Simpler Stream Week from June 21st to the 23rd for live market analysis. And guess what? It's all free right here on YouTube.
Everybody, this is John. Welcome to the free video. So let's look at the biggest bull market that's happening out there right now, and that is in interest rates. So after a huge rally here, we've consolidated, nice cup and handle pattern, and we are exploding again. So of course this is the 10-year interest rate. Closed today at 3.4, well basically 3.5%. Highest it's been since 2010. So mortgage rates typically are almost double whatever the 10-year note is. And so today I think they were around 6.5%. So you have mortgage rates exploding. Now there's fears, of course, of the housing market crashing. Believe it or not, at least in Austin, I know it's different everywhere, kind of a healthy, balanced market has about 6 months supply of real estate. And the headline today was that inventory has tripled. Okay, well, it's gone from basically 1 week to 3 weeks, almost a month. So just to kind of keep that in mind. So sales have slowed. I bring this up because although I do think real estate is going to pull back, it's not the 2008 crash. Technically, that's not supposed to set up for till 2026. But I bring this up because what we are having is the fastest fiscal tightening in history. We've got the dollar, we've got commodities, i.e. oil, wheat. We've got interest rates all going up at the same time together, and at the rate that they rarely go up together, first of all, and they've never gone up together as fast as they are now. And we're seeing, of course, this is, and I've talked about this a couple of times, is that the idea that everything's just undergoing a decelerated valuation. So everything from, what about Bitcoin and gold? Well, Bitcoin and gold aren't hedges against inflation. They're hedges against negative real interest rates. That's why crypto and gold and silver do really, really well during quantitative easing, but aren't, we can already see how crypto is doing, of course, in an environment like this as an inflation hedge. And then gold is often mistakenly used as an inflation hedge, but it is really more about real negative interest rates. And of course, there can be some spikes. And I'm not bashing gold. I like it. You just want to know when it's good to have a lot of it. So this all being said, the last man standing here as an asset is oil, and oil is essentially the last thing that the Fed is looking at here to say, gosh, if oil can come down, maybe all this whole inflation stuff will stop. And I think they're going to make a mistake of kind of overshooting a bit. In a way, that's good news, because when they overshoot and the economy starts slowing more than they hoped, or most importantly, unemployment potentially starts to fall. Rise. Job creation, all that. The last unemployment report was so strong, it took them back. It took them, kind of made them to pause. But we're starting to see layoffs and things like that too. I think a combination of oil kind of coming down. It's already showing signs of topping. We've already seen natural gas roll over and die today, respectively, from its highs. Then the Fed can put on the brakes a little bit. I think what's going to happen is tomorrow on Wednesday, they may actually do like a 3/4 of a point rate hike, because they're so frightened right now by inflation and all this kind of stuff, and gas prices keep going up. And I think, honestly, they need to. They need to quit screwing around. I mean, they've been like, oh, this is transitory and blah, 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 blah. If they do like a 3/4 of a point rate hike, I think that'll kind of shake the markets up, but then everything will stabilize instead of this hurry up and wait BS. So what do we buy here? This is a tricky place to buy anything, honestly. It's been a great day trading market, SPX, zero-day expiration options and stuff like that too. If you are looking to bottom fish on something, any stocks that are over 80% down from their highs are actually decent candidates that actually are a real business and have revenues. Something like Zoom may have already put in a bottom. It's kind of forming a head and shoulders kind of a reversal here. What about something like the Qs? A little trickier. Of course, they are down now over 50% from the COVID lows to the post-COVID highs, and we're at a spot here where it makes sense that it would pause, but I don't think we've seen the lows yet. I think for the spiders, we may actually end up getting down to 320. Again, I don't know exactly when a market is going to bottom out like that. It's just going to depend a lot on the Fed. The last point here, though, is that no market goes straight up or straight down. We have had 3 down days in a row leading up to this Fed meeting. That has happened 25 times since 1990, and 21 out of 25 times in that scenario, the market has actually gone up after the Fed meeting. So the odds are that at the very least we have a reversion back to the mean. So I'd be careful on the short side tomorrow. Remember, the name of the game in this environment is to protect what you have and then be patient for the opportunities that give you a high probability of success, versus, betting it all and hoping. So that's what I got. Got a lot to cover in the premium video. You guys have a great night, and I'll see you at the next update.
Hey, John here with Simpler Trading. Thanks for watching. If you enjoyed this video, comment down below and let us know what topic you want to see us cover next. Also, be sure to subscribe and click the bell icon so you can get notified when we release new videos. And if you want to watch us trade in real time using our own money, go to simplertrading.com and learn how to sign up. Good trading, and we'll see you next time.